All right, class, in this lesson, we are going to learn about basic credit terms. We're going to identify types of lending institutions and also compute finance charges for installment purchases. Okay, let's go ahead and get started with some terms. So what are some of the things you need to know before using credit? Okay, so there are two different general scenarios that could take place when you're buying goods and services. There is the buy now and pay now, right? So you buy for goods and services and you pay it in full today. And then the other option is to buy the goods or services, but then pay it later or pay it in increments. Now, a person who uses credit is called a debtor, and then an organization or person that extends the credit to you as the debtor is called a creditor. Now, there are some advantages and disadvantages to doing this. One of the advantages of using credit is that you can shop without carrying a lot of cash. That was certainly the case before debit cards became a tool, although now that is becoming less of an advantage. And then the other advantage is that you can get use out of the product that you are purchasing without having to pay in full. So you get to use it right now and then pay it over time. Now, there are some disadvantages to using credit. Number one, it's going to cost you more, meaning the creditor is going to charge you interest. And then when you have the ability to buy things without having the complete funds available, there's also a psychological tendency to spend more than you should, okay? There are a number of other disadvantages that also exist with buying things with credit, but we're not going to go into that right now. But just be aware that when you use credit, it creates a level of complexity well beyond if you were just to pay it in full. Okay. So let's go ahead and move forward with some additional terminologies. So in any type of credit type of transaction, understand that the underlying theme or understanding between the two parties is that there is a level of honesty. Creditors need to be sure that they will be paid back before they extend credit to you. Okay, creditors will check your financial history. There are three different areas. Number one are assets. This doesn't happen with all types of credit, but these are possibilities. Assets are things that you own, physical things, your home, a car, bank accounts, and other personal possessions. The other thing that creditors will also look into is your earning power, not just how much you make now, but what is your ability to make even more money in the future. So that's important to them if they decide to extend credit to you. And then there's also the credit rating, which is your credit score or your credit report card that is issued by a credit reporting agency. And there are three major credit reporting agencies in the United States. They are Experian, Equifax, and TransUnion. And what they do is they compile records on all of your use of credit through banks, auto loans, home purchase, mortgage companies, anything to do with finance. They will collect that information and consolidate that. And all of that information is then used to calculate a credit score called a FICO score. And FICO stands for the company that created it, and that was Fair Isaac and Company. Credit scores range from 300 to about 850, where 300 is really a bad credit, whereas if you move to the other end of the spectrum towards the 800, 850 range, that means that you have really good credit. And to have good or bad credit ultimately means your ability to pay a creditor back. So the higher score creditors like because they know that they can trust you and you are more than likely to pay them back. Gender, race, religion, nationality, and marital status do not affect credit scores. Any transactions involving credit, you should understand, is a legal contract obligating you to make a timely payments. So to use credit responsibly, you need to know the language of credit and the laws that protect creditors and debtors. And this can be fairly complicated, but you should understand some of the general rules. All right, so some stores will offer credit-worthy customers the convenience of paying for their merchandise or services over a period of time. And when they do that, they are issuing what's called an installment plan. In this plan, the customer pays part of the selling price at the time of purchase, which is called the down payment, and then you're going to end up following a schedule of payments or installments, and those are usually done on a monthly basis. So they kind of figure out, okay, you're going to pay X amount of dollars every month for the next however many months until the product or service is paid off. So one thing to realize is that when you purchase something on installment, you are immediately paying interest on the purchase amount. So that monthly amount that they describe as your monthly payment will include the cost of the goods and service, plus they tack on a certain amount of interest. So just be aware that you are being charged interest. And then installment plans differ from what's called a deferred payment plan in that the interest charged to you is deferred or delayed as long as you pay in full during the term of the loan. So credit cards will offer things like 12 months interest-free. That's considered a deferred payment plan, and they will require you to make a minimum monthly payment, but you need to understand that interest is accruing behind the scenes, and if you don't pay back the full amount by the end of the term, all of that accrued interest will come back to hit you, and you will owe money on that interest. And then lastly, the other type of plan is called a layaway plan. This doesn't happen is not offered as much today as it had been back in the 80s and 90s. But what this does is that the customer buys a product, but they don't get to take the product right away. They agree to pay it off over time. And so the merchant will hold on to the product on your behalf, usually for a fee. And then once it's paid in full, plus the fee, then you can take possession of the product. Okay, so let's go through some examples on what some of these calculations might look like. So in example one here, we've got Heather wants to purchase an electric guitar. The price of the guitar with tax is $2,240. The question here is, if she can save $90 per month, how long will it take her to save up for the guitar? Okay, so this is a fairly straightforward calculation. We would take the total cost plus tax, so that's $2,240, and we're going to divide that by $90, which is what she is going to pay per month. And when you do, that works out to 24.89 months, or we round that to 25 months. So a little bit over 2 years to save up for that. So as you can see, if you decide to pay for something and you don't have enough money, it takes a while to save up that kind of money to be able to purchase something that she wants. And that's okay to take that much time, because the other option is to go into debt or get credit for it. And that's what we're going to see in the next example. So Heather speaks to the salesperson at the music store who suggests that she buy the guitar on an installment plan. Okay, so let's take a look at what this might potentially cost. Here it says that it requires a 15% down payment, so that's the initial part of it, and then the remainder, plus a finance charge, which is interest, is paid back on a monthly basis for the next 2 years. We're told that the monthly payment is $88.75. Okay, so that's less than the $90 that she wanted to save up earlier, but we need to figure out what is that finance charge. Okay, so the first thing to do is we need to figure out what the down payment amount is, and we are told that it is 15% of the total price. Okay, so $2,240 times 0.15 works out to $336. Okay, so that is the down payment. So if we subtract 336 from 2,240, that works out to $1,904. Okay. And then the next thing is we're told that she pays $88.75 for the next 2 years. So let's figure out how much she's going to end up paying on top of the down payment of $336. So we're going to take $88.75 and we're going to multiply that by 2 years, which is the equivalent of 24 months. And that works out to $2,130. Okay. Now we're going to have to subtract $1,904 because that was the balance of what's remaining after the down payment. And this works out to $226. So Heather is going to be paying $226 in finance charge for this type of installment plan. So it's going to cost her even more. So the total cost really is this $226 plus the $2,240, which works out to $2,466. Okay, so the cost of wanting it now, even though she doesn't have the money, will cost her $226. So that is the trade-off. If you wanted to buy this on sort of an installment plan or quote-unquote credit, it's going to cost Heather more. Okay, so let's go ahead and move on to example 3. Carpet King is trying to increase sales and it has instituted a new promotion. All purchases can be paid on the installment plan with no interest as long as the total is paid in full within 6 months. There is a $20 minimum monthly payment required. So if the Garcia family buys carpeting for $2,134 and makes only the minimum payment for 5 months, how much will they have to pay in the 6th month? Okay, so let's take a look at this. Minimum payment is $20 times 5 months means that they will only have paid $100 toward the total purchase of $2,134. Okay, so now we're going to need to take $2,134 and subtract the $100 that they will have paid in the first 5 months. Okay, and this will work out to $2,034, which is what they will have to pay in month 6 to avoid finance charges. Okay, all right, let's go on and move to example 4. Here, Lindsay purchased $4,322 worth of home appliances on Home Depot's deferred payment plan, which allows her to make no down payment and no payment at all for 3 months. If the entire $4,322 is not paid in full before the 3 months is up, there is a finance charge with an APR of 21.6% applied each month going back to the first month. If Lindsay makes the full payment a day after 3 months expired, what is the finance charge? Okay, so this is a scenario that many of us could find ourselves in, where we have the option of buying all of this product from a place like Home Depot or Lowe's or some other store, and we are exempt from making any sort of down payment, possibly any monthly payment, but what we don't know is that APR or interest is accruing behind the scenes. And we have a certain period of time. Today they offer 12, 18, 21 months to pay it off, and they stretch it up long enough so that you kind of forget about it. But let's take a look at what happens if we're doing this in 3 months and what it does in terms of interest charges if we don't pay this off. Okay, so the way to figure this out is we're going to take $4,322, okay, and we're going to multiply that by 21.6%, okay, but this is on a monthly basis, so we have to divide this by 12, okay, and remember, we have to convert this percentage into decimal, so that's going to be 0.216, okay, and if we go ahead and calculate that out, it works out to $77, and this rounds out to 80 cents, okay? That's month one. And then what happens is, remember I said that interest charges are accruing behind the scenes? This is what happens. So now we're gonna take the $4,322 and we're going to add $77.80, okay? And this works out to $4,399.80. So that is how much she's going to owe at the end of month one. Okay, now we got to do the same thing again for month two, except now we're going to start with $4,399.80, and we're going to multiply that by 21.6% divided by 12. Okay, and punching that in the calculator gives us $79.20. Okay, so that's the end of month two. So now we're going to tack this amount onto the $4,399.80. And when we do, this works out to $4,479.00. Okay, so that is how much she will owe at the end of month two. But we're also looking at the end of month three, so we need to do this one more time. So we're going to take $4,479, and we're going to multiply this by 21.6% divided by 12. And punching that into the calculator, we get $80.62. Okay, so we want to know how much she owes at the end of month three, since the promotion expires then. This works out to $4,479 plus the $80.62. And that works out to $4,559.62. Okay, so what ended up being the original cost of $4,322 has now skyrocketed up to $4,559. Okay, and that's if she doesn't pay this amount off within the 3 months promotional period. So as you can see, this becomes very, very expensive if you miss the deadline even by 1 day. Okay, so let's go ahead and move on to the last example in this lesson. Here we've got Vivian, who purchases a 60-inch TV for $2,045.15, which includes sales tax, and she puts it on a 6-month layaway. The monthly payment is $361. The question here is, what is the sum of the monthly payments, and what is the fee charged for the layaway plan? Okay, so monthly payment of $361 times 6 months works out to $2,166. The original amount of the 60-inch TV was $2,045.15. So if we subtract that from what she's going to end up paying, we get $120.85. And so this is the fee that Vivian will be charged. if she puts it on a layaway plan, and the answer to the first question, what is the sum of the monthly payments? That's $2,166. Okay, hopefully going through this exercise helps you to understand some of the benefits and hopefully some of the disadvantages of buying products or services on credit. If any of this was confusing to you, if you need further clarification, please go back to the beginning of the recording and listen to it again. Thank you.